Welcome to The Explainer. Today, we're pulling back the curtain on one of the most powerful yet, honestly, widely misunderstood concepts in trading, the breaker block. If you've been trading smart money concepts or tracking institutional order flow, you already know the market doesn't just move randomly. It moves to hunt liquidity. So today, we're going to decode those exact movements, uncover the secrets of these institutional traps, and actually show you how to turn a failed setup into your absolute highest probability trade.
We've all been there, right? You do your multi-time frame analysis. You find a picture-perfect bullish order block. You patiently wait for the price to drop into your zone, you execute your long position, tuck your stop loss safely below the low, and then, bam! The market just smashes right through what was supposed to be a rock-solid support level, trapping your position and stopping you out entirely. It's an incredibly frustrating, almost insulting rite of passage for traders. But what if I told you that this failure isn't random at all? What if that broken order block is actually handing you a blueprint for the real market direction?
So, here is our roadmap for today. First, the institutional trap. Second, the breaker block defined. Third, bullish versus bearish anatomy. Fourth, the step-by-step setup. Fifth, breaker versus mitigation blocks. And finally, number 6, the unicorn model.
Okay, let's dive right into Section 1, the institutional trap and how the market hunts liquidity.
You see, order blocks often fail entirely on purpose. It's a concept known as liquidity engineering. Institutional algorithms regularly manufacture these stop hunts to secure the counterparty liquidity they need to build their massive, large-scale positions. Think about it like this. In a bullish trend, retail traders are placing their protective sell-stop orders just below a confirmed bullish order block, right? Well, when higher time frame order flow dictates a trend reversal, smart money algorithms drive the price aggressively through these support zones specifically to harvest that accumulated stop-loss liquidity. This rapid expansion traps retail buyers while simultaneously tricking breakout traders into taking premature short positions. It's a total trap.
Moving right along to Section 2, the breaker block defined, or as I like to call it, the structural flip. So a breaker block is fundamentally a failed order block, but it only becomes a valid breaker when it flips its structural role after two very key events, a liquidity sweep and a market structure shift. When the price breaks heavily through an order block, the trapped buyers or sellers are sitting in deep, painful drawdown. When the price eventually retraces back to this broken zone, those trapped traders desperately close their losing positions at break-even. This creates a surge of localized buying or selling pressure that perfectly aligns with the new directional flow. Think of it as a shattered floor suddenly becoming a concrete ceiling.
And this brilliantly illustrates the exact moment that transition happens. We have a series of bullish order blocks pushing the price upward. But notice that final red box. That was a bullish order block that completely failed to push the price higher. The price just sliced right through it, breaking the market structure. Now, as the price pulls back up into that exact same red zone, it acts as firm resistance. That failed bullish order block is essentially flipped into a highly reactive bearish breaker block.
All right, Section 3, bullish versus bearish, breaking down the structural anatomy.
Let's neatly contrast the two variations here. For a bullish breaker, the market forms a low, then a high, then a lower low. Now, this is the liquidity sweep that traps the sellers. Immediately after that, it rallies to form a higher high, breaking structure. The bearish candles that formed before that swept low, those become your bullish breaker zone. Conversely, a bearish breaker requires a high, a low, a higher high to trap the buyers, and then a violent drop to a lower low. This specific sequence of highs and lows is absolutely critical because it mathematically proves a complete loss of control by the previous trend.
Next up, Section 4, the step-by-step setup, basically your execution blueprint.
The crucial point here is sticking to this 4-step checklist. Step 1, wait for a clean liquidity sweep at the extreme of an old order block. Step 2, ensure the price decisively breaks the order block. We want to see a full candle body close past the zone, not just a little wick. Step 3, confirm a market structure shift on your lower execution time frame. And step 4, honestly, this is where most traders fail. You must have the patience to wait for the retest of the broken zone. Do not chase the breakout. Seriously, let the price come back to you.
Now, because we're dealing with high volatility reversal zones here, strict risk management is just absolutely non-negotiable. To enter, a lot of traders target the 50% retracement of the breaker block, which is known as consequent encroachment. Your stop loss must go 10 to 20 pips beyond the swept extreme, not just tightly tucked behind the block, because smart money often hunts those really tight stops before reversing. Target the next major liquidity pool and absolutely limit your risk to 1 or 2% of your capital. Remember, even a great setup doesn't make you invincible to market volatility.
Okay, Section 5, breaker versus mitigation blocks, knowing the exact difference.
If you look at a chart, breaker blocks and mitigation blocks can look incredibly similar, but their underlying narratives are totally different. The defining difference is the liquidity sweep. A breaker block only happens after a stop hunt, a new higher high or lower low that actively sweeps liquidity before the structure shifts, so it's a reversal trade. A mitigation block, however, happens when the market fails to make a new high or low. There is zero liquidity sweep. The price simply returns to mitigate or close out underwater institutional positions before just continuing in the exact same trend direction. Simply put, sweep equals breaker, no sweep equals mitigation.
And finally, Section 6, the unicorn model, representing extreme confluence.
Now, what's really interesting here is how this setup takes the structural shift of a breaker block and perfectly overlaps it with a price inefficiency known as a fair value gap, or FVG. When these two zones intersect on a chart, boom, they create the unicorn zone. Why is this so incredibly powerful? Because you're stacking a trapped trader liquidation event with a severe imbalance in price delivery. It basically creates an area of extreme institutional confluence that is highly reactive and offers just incredible precision for your entries.
Relying on multiple, overlapping signals is exactly how you protect yourself from false breakouts. When you have a structural flip perfectly aligning with a price inefficiency, you filter out a ton of the noise. This confluence dramatically improves your risk-to-reward ratio and gives you the sheer confidence to execute when the market seems, well, chaotic. It is, quite literally, designed to maximize your edge.
We've covered a massive amount of ground today, transitioning from the raw pain of a trapped position to the absolute power of a verified structural flip. The very next time you watch a perfect support level get smashed to pieces, don't panic. Watch for the sweep, wait for that structural shift, and look for the retest. Which leads me to this final thought to leave you with today. How will you adapt your psychology and your risk management the very next time your order block is swept? Keep studying those charts, stay patient, and always let the smart money show their hand first.